In most states across the U.S., automotive dealers are required to have a surety bond as a condition of licensing. Because this surety bond requirement is widespread and underwriting is typically straightforward, it's a great bond to produce from an agency perspective. With features like preferred rates, flexible and fast underwriting, and an industry-leading website, Merchants Bonding Company is an excellent market for your motor vehicle dealer bonds. Hi, I'm Eli Cranbeer, commercial surety underwriter at Merchants. Let's get started. What are motor vehicle dealer bonds? Motor vehicle dealer bonds guarantee that a licensed motor vehicle dealership will comply with state regulations. These bonds are meant to protect consumers from fraud and other wrongful actions committed by dealerships and their employees. Who needs motor vehicle dealer bonds? In addition to car dealers, motorcycle dealers, mobile home dealers, and others like boat dealers may need bonds depending on the state's statutes. There could be different requirements for new and used vehicle dealers as well. Some states require a bond for each location. You can find out specific requirements by signing into our simple and intuitive bonding website, The Hub, and searching for the bond you need. What is the required amount? The requirement can range from $10,000 up to $300,000, depending on the state. Usually a state requires a set limit for all dealers, but some states have variable limits depending on how many vehicles a dealer sells. How much does the bond cost? The rates for motor vehicle dealer bonds are typically $10 per thousand, or 1% of the bond penalty amount. Merchants has preferred rates in many states. Sign into the Hub to view prices instantly without entering any customer information. What information is needed for underwriting? Merchants always takes the common sense underwriting approach. Depending on the state and bond limit, Merchants generally underwrites motor vehicle dealer bonds with a signed application, including business and personal indemnity, and a clean credit report. For larger bonds, business and personal financial statements are also needed. Merchants is unique because we will consider personal financial strength in addition to business financial strength when making our bonding decisions. This is especially helpful for smaller, newer dealers. Sometimes additional factors may be considered for larger bonds, like the number of years the dealership has been in business, the number of cars the dealership sells annually, any prior violations or bond claims, if liability insurance or other appropriate coverages are in place, the number of locations operated by the dealer, and whether the dealer is a member of local and state associations. It is often easier for franchise dealers to get surety credit due to the capital requirements to open the business. In some cases, personal indemnity may be waived for well-qualified franchise dealers. What happens if a claim is filed? All motor vehicle dealer bonds work in the same basic way. If a bonded motor vehicle dealer breaks the bond's terms, the damaged party can make a claim against the bond for compensation. Proper claimants vary by state, but are typically the customer, bank, or government agency. The surety will pay out the claim if warranted, but the dealer is responsible for paying the surety back in full. How are bonds issued? Motor vehicle dealers should get in touch with their insurance agent to help walk them through the process. The agent will work with Merchants Bonding Company to issue the bond, and bonds can usually be issued the same day. Contact Merchants Bonding Company for agent recommendations in your area. If you have any questions about motor vehicle dealer bonds, you can contact us at info@merchantsbonding.com. Reach out and one of my colleagues or I will be glad to assist you. Sign into the Hub or contact us for specific state requirements. I'm Eli Cranbeer for Merchants Bonding Company.